Hello, everyone. I'm Ted Oakley, managing partner at Oxbow, and I'm really happy to have a friend and a guy that knows gold as well as anybody I know in the business. He's been at it a long time. It's my friend John Hathaway, who is managing partner of Sprott. And John, certainly glad to have you today.
Great to be with you, Ted. Thanks for asking me back.
Well, I know Sprott has had so many good things happen as far as all the ETFs and various things you brought out the last few years, and obviously nailed the market with gold. But I was going to ask you, kind of start off with what makes you think? What do you think makes this bull market in gold different from prior bull markets?
That's I have to ponder that for a second because I've been through a couple of these now, and I think the issues that drove gold, let's say in the bull market from 2000 to 2011, are a lot of the same reasons. Federal deficits, fiscal issues, geopolitics always factors in one way or another. But I think today those problems are just seem so much more intractable, particularly on the fiscal issues for the U.S. and basically Western democracies in general. So you're seeing an increased amount of questioning as to all paper currencies, the U.S. dollar being the premier amongst them, as being a safe place to store value. So that was true back in 2011. It's just more true today because the problems are so much worse.
And don't you think this? We've never seen this before. Well, maybe you've seen it. Maybe you know better than I. But this other central banks are buying gold. All these other countries. That certainly, don't you think, had a big impact?
That is certainly a factor. And again, the reason central banks are adding to their gold reserves is for those reasons, that they don't trust the dollar in particular. The dollar, of course, has been weaponized in large part because of the war in Ukraine. And all of our trading partners could see that it was something we were willing to do. And so, again, it all comes down to from official institutions, from institutional investors and individuals. Is the dollar a good place to store value? And I think the consensus today is greater than it ever has been that it's not. And so gold gets the nod as a diversifier and a safe haven.
Did you see when they froze the Russian assets? Did you see that? Do you see that as a turning point for when they really started to buy a lot more gold?
That was certainly one of them. That was certainly one of them.
Yeah, because it seemed that way. You know, a question we get all the time too, obviously on the gold and the miners, and I'm sure you get this question a lot in your business because you're all metals, but is it's had a good run, but is it over? Everybody's asking that. Is it
Of
over?
course.
And nobody knows the answer to it, but I'm sure you have some similarities you could draw maybe of
Yeah, well, I mean, nobody knew it was beginning because nobody's there. So, and we just wrote something. It was a team effort. The PM team that I'm part of at Sprott, because that's the natural question. Gold has outperformed the S&P for the last 12 months. Gold mining stocks have outperformed gold. And if you look at a 3, 5, and 10-year interval, gold mining stocks have been the top performer. Now, a lot of people would be surprised to hear that. So, but it's a fact, and it's happened without participation. So long-winded answer to your question is, I don't think it's over because nobody's there. People are afraid to get on board, which is understandable. I would say this is a time when you would think about buying the dips more than any. You wouldn't just jump on board without any sort of tactical considerations. But the fact that it's so under-owned and has done so well, I think makes it compelling to have some strategic allocation both to the metal and to the shares.
And it's interesting because if you look at the S&P sectors and look at materials, there's one gold miner in there, Newmont. That's
right.
it.
That's right. They're not. So, it used to be that, well, this space isn't investable because it's got too small a market cap, which to me is an argument in its favor. It just makes it harder to get in. But as the share prices rise, the market cap of the space has grown. And I think it's knocking on the door of about $1 trillion now.
Well, I don't know if this, you wrote a piece a couple of months ago that I personally think is probably the best piece I've ever read about gold. It was called A Cure for Financial Dementia.
Oh, thank you.
And it was really, really good about gold and all the things that surrounded it. Hopefully it's still at your website. Maybe people want to go there.
Yeah, it's definitely still there, posted.
But I thought it was really good. But what I want
Thank
to
you.
ask you about that I don't think most people understand is you have a graph in there of the numbers for AISC, the all-in sustaining costs. And might get you to talk about that just a second, because I don't think people realize the immense profitability of gold miners right now.
Yeah, and then that's the core argument for value and for the attractiveness of mining stocks. The global all-in sustaining cost, which is essentially cash costs plus what you need to reinvest in the business in terms of exploration, maintenance capital, and that kind of thing, is roughly $1,600 an ounce. And of course, the metal price today is a little bit north of 4,000. So the profit margin per ounce is $2,400, let's say. And you have, as a result of that, gross margins that kind of look like Microsoft, which, except it's a mining business. And, people don't think of it as being that profitable, but at least for now, in this world where we are, it is one of the most profitable businesses that you can name.
Do you see a lot of merger activity starting to happen in the business?
There is a lot of merger, and the kind of mergers that we like and that we've participated in is where you have a neglected asset. You take a company like Newmont and I can't give you the exact number, but they may have 20 or even 25 different mining sites globally. And it's impossible for management, even though Newmont is a well-managed company, to pay the kind of attention to all of those assets that they need to get the best out of them. So Newmont has been gradually selling off some of these assets, and they sell them at a price where the asset hasn't been I wouldn't say well, but it has not been given the most attention that it needed. And when the buyers tend to be smaller companies where there's a huge incentive, obviously, to improve the profitability, maybe a better delineation of reserves, those kinds of things, which can make a huge difference. So we see a lot of that And those are some of the real success stories in the mining space.
You know, I was going to ask you too if you. I looked at the move from the 70s up until January 1980 in the gold price, and I just sort of extrapolated in today's prices, and it looked like it'd be like over 6,000 if you had the same kind of move. I'm not saying that's going to happen. I'm just saying one of the things that happened then, and I was going to ask you about this, is that Volcker came along in 1981 and 2 and said, look, we're going to stop all of this nonsense. And when he did, real rates, you know, obviously went a lot higher. Wasn't really good for gold because you were going the other way. Now, I'm asking you this question too. It seems the reverse. Seems to be about runaway deficits, runaway debt. Nobody trusts the dollar. Nobody trusts the bonds. Do you see it that way?
Yeah, those are all, first of all, there's no Paul Volcker in sight. There's no mandate. I mean, look at who's in the White House. Look at the people surrounding him. I mean, there's no constituency for sound money. I can't think of a better way to put it. You would think Besant knows better, but maybe he's just caught up in the moment where he's Treasury Secretary, and probably if he tried to pull a Volcker, he'd be out on his ear in 2 seconds. So we have low real interest rates. You know, there's not a chance, snowball's chance in hell that that Powell is going to not reduce rates. And, you know, who knows who the next Fed chair is going to be, but he'll be very friendly to Trump's agenda, which is, at the end of the day, pretty inflationary and certainly very low interest rates. So that's a tailwind that we have today that that we didn't have, and this is actually before my time, in 1980 when Volcker basically ratcheted down inflation by having sky-high interest rates, and he had the backing of the White House to do that.
Well, I know in the piece you did, one of the pieces you did, I think it was late 24, you had a quote by Scott Bessent, the Treasury Secretary, that he had 20% gold. Is that right?
Well, I think what Bessent said is that gold was he had a large investment in gold, and it was his favorite position.
Oh, that's what it was. Okay, that's what it was. Yeah.
And so what you might be thinking of, and this is important, is the chief investment officer of Morgan Stanley, Mike Wilson, and this was carried on Reuters in September, and it's similar to what Goldman Sachs, their head of commodities research, put out in May, basically saying that the 60-40 risk parity portfolio model, 60% equities, 40% bonds, for risk diversification no longer worked. And the reason it didn't work is because bonds have generated such disappointing returns, again, getting back to the distrust, the reasons for distrust in paper currency. And both Goldman and Mike Wilson at Morgan Stanley said, you need to up your allocation to gold. In the case of Morgan Stanley, and I'm still scratching my head about, did they really think this through? 20%. So you do the rough math on that, and neither Goldman and I'm particularly thinking about Morgan Stanley, understand how illiquid gold is in the context of capital market flows. So quick and dirty math, there are, I believe, 125 trillion of global equities of all shapes and forms under management. 20% of that would be, let's call it 11 trillion. Well, and we've done some work on this, the float of physical gold, I know everyone says all the gold that's ever been mined is above ground, but it's not in marketable form. And so let's say 11 trillion has to be invested in maybe 4 trillion. And you think about that, if that were to take place, for the market to balance, you would need a price in well into 5 digits. And I'm not one for predicting prices or picking a time or anything like that. But to the extent you have mainstream money flowing into gold, which is, I think, where we are, I think the surprises will be how illiquid gold is and how much higher it can trade and stay there, not just reach a peak and then come back, because the buying that could be unleashed by the Morgan Stanley 60-20-20 instead of 60-40 is huge relative to the size of the quantity of gold that can be bought.
Well, it's interesting. We tell investors that, look, when you own gold in the miners, anything has this possibility. But if for some reason you were to get a 10 or 15% shakeout in gold, we tell them, look, don't use that as a period that you want to get out. Because probably, more than likely, if you're going to point to a much higher price later on, and we try to get people to settle down in that investment and understand, it's a long-term thing. And I know we've had a little hotter money, I think, come into gold, but not that much. I think September we finally had a little money come into the GLD ETF and things like that. But do you think investors will hold tight on that if you were to get a little selling?
No.
I don't either. I wish they would, but because I think they'll make a big mistake. If you think about the next 3 to 5 years, you think they really make a big mistake if they do that.
Yeah, the world would have to change a lot for that to be for a strategic allocation to gold of, let's call it 5%, for that to look bad. And let's pretend it did look bad. Well, that means the 95% you had and everything else would be fine. So it still makes me scratch my head why it is such a forbidden that gold is so controversial. I think it's becoming less so, which is kind of interesting. But to me, and it used to be conventional wisdom, this is before you were born, but not me, in the 1960s and 70s, that a standard allocation of 5 to 10% was mainstream. That was where you were supposed to invest. And that all went away after Volcker basically killed the inflationary dragon.
And John, if you look at the selling, it was short term, but in late 08, early 09, gold and the miners came off. But man, they were one of the first things to come right back. I mean, a year later, you had it all back. You were rolling, and then you went on to make new highs in 10 and 11. And people made a real mistake then of trying to turn the miners and turn gold at that time, I think.
Well, this is to be fair, in 2011, everybody was afraid of inflation. Inflation did not occur. They were afraid of inflation because the Fed was, quote, printing money, quantitative easing, ultra low, below market interest rates, all of that. And all the smartest people thought this would lead to inflation, which didn't materialize. And instead the markets took off, and that left gold in the icebox for probably 6-7 years. But then you go back and say, to your point, if you had made a commitment to gold, even if you bought it at the top in 2011, which would look bad for a couple of years, and you think about the fact that gold is and mining stocks have outperformed the S&P for the last 10 years, you had to wait, you had to endure a period of bad performance. But if you made your allocation sensibly, and I'm going to say 5%, it didn't kill you. And, with 2020 hindsight, it would have been great.
It's interesting because if you look at the central bank buyers, and these are countries that the U.S. is always trying to strong arm. But you look at Russia, India, China, they're really buying a lot of gold. And the U.S. has a tendency to think that they can sort of overrun those countries when I don't think they can because of how we are geopolitically and the world set up today. And then you got countries like Canada that has all those gold reserves up there. And I don't think central bank, I don't think they own any gold in their
No, I don't think they do either.
And so it's kind of an interesting world as far as that goes. But I'll ask you one or two more questions, but one of them is this. I'll switch subjects on you. And I know obviously your history has been in gold, but do you have any thoughts on silver?
Sure. I mean, silver, it's a monetary metal, which means that it's influenced by trends in gold. It's a smaller market cap, so flows into silver, you don't need the same flows into silver to move the price as you do in gold. It looks to me like right now there's a huge short squeeze going on because lease rates are sky high. But the other side of silver is that it has many uses industrially that are growing. And I couldn't name them all. We have an expert within our group, Maria Smirnova, who can cite chapter and verse on this. But silver it's a growth metal. It has uses in solar, medical, and I couldn't even begin to name all of them. But so it has a dual personality that gold doesn't.
So sort of my last question to you would be this, and that is, and you've sort of referred to it in a way already, but to the average investor out there, okay, the average investor, that what percentage of that portfolio do you think should have a gold allocation to it?
And that's a question that we get a lot, and I think it's a good question. To me, gold, the bullion, is a safe asset. And so each individual would come to this from their own perspective. Are they risk takers, or to the extent that they're risk takers, or to what extent are they just interested in capital preservation? And I would say at the low end of the scale, I would say just a couple percent. But if you're essentially interested in capital preservation, I think 10% is not crazy.
And if you just do 1 or 2%, John, I'm not certain you're really going to get anywhere.
No, it's like kissing your sister.
Yeah.
I mean, it's why bother? You're right.
Yeah, and then I see, we have a lot of people come and look at our website and different things, and sometimes there'll be like 90% gold in miners. So
that's only for the faint-hearted.
Yeah,
not for the faint-hearted.
They go the other way, but it is something. I know all three of our strategies have either miners, we have bullion in both 2 of the 3, and in the stock strategy we have the miners. What do you think about What do you think about the royalty gold miners? Royal Gold, Wheaton, those kinds of companies. Franco?
Yeah, they're terrific companies. In my mind, they're like merchant bankers. I mean, they get a participation in metals prices. They get a participation in asset growth, reserve growth, discoveries, all that sort of thing, without getting their hands dirty, because they're basically, if you look at a Franco or a Silver Wheaton, with these market caps and hundreds of millions, maybe even billion in a couple of cases, but they have maybe 10 people in the whole company.
Yeah.
So they're not shoveling dirt the way the miners are.
Right.
And they're getting a ride on, because they've been smart financially, putting capital to work to help miners build their assets. So I think it's an intriguing subset of the mining space.
Well, John, I want to thank you. This interview is going to come at a really great time, because everybody that owns gold is feeling good. Everybody that doesn't own it wishes they did, probably. And a lot of questions about it right now. So I think it's been really apropos to be talking about it today. But let me, where's the best place for investors to come and look at what Sprott's doing in this area?
Well, Ted, we have a terrific website. Sprott Inc. is probably the best way to find it. And it's just loaded with information, not just on gold and precious metals, but we've made a big foray into uranium. So there's information on that. I think copper would be another thing. So it's a very it's not promotional. It's a very educational website, and I would suggest that as a starting point.
And let me close this out by asking this, since you just mentioned that. Do you feel like, we're talking about all those metals and different things, do you feel like the next 5 to 10 years we're going to see a resurgence in the basic commodity market?
The answer, as long as there's economic growth, I would say the answer is yes. So, a quick answer.
Yeah. Well, the metals part of that are certainly driving it, to a degree, and we'll have to see how that goes. But John, I want to thank you very much. Always good to see you, and hopefully we can have you back next year.
Thanks, Ted. Appreciate it.
All right. Thanks. Hello, everyone. I just want to say, if you like this video and you want to see more of this type of information, because we really try to get the information that you don't see from anybody else, then be sure and click on subscribe, and you'll see more of what we do here at Oxbow.